Hello friends, I welcome you once again in my video class. So today we have reached unit 10, that is the name of the unit is risk regulation in banking industry. And this is the module B of BFM. So starting with the chapter, we first start with the what is Basel 1. Okay, so Bank for International Settlements situated in Basel. Basel is the name of city in Switzerland. It was moved due to the effect of collapse of her state bank in Germany in 1974. Okay, I'll show you the date once again here, 1974. Okay, so Basel Committee on Banking Supervision consisting of 13 members of G10, Group 10, met at Basel and released guidelines on capital adequacy in July 1988. So this was the July 1988. These guidelines were implemented in India by RBI with effect from 1st April 1992. Okay, that means the Basel 1 was implemented in India on the recommendation of Nirsamman Committee. On the recommendation of Nirsamman Committee, this Basel 1 was implemented in India in the year 1992. What was the basic objective? The basic objective was to strengthen soundness and stability of banking system in India in order to win confidence of investor. Okay, because investor are the main source of income for the bank. Okay, when investor they invest their money, then only the bank is able to lend the money to the borrowers. Okay, and to create healthy environment and meet international standard. And so we'll see 2 3 more points. BCBS meets 4 times in a year. What is the full form of BCBS? Basel Committee on Banking Supervision. Basel Committee on Banking Supervision is the full form of Basel. Okay, so BCBS meets 4 times in a year. Presently, there are how many members? 27 members. So this is not important. BCBS does not possess any formal supervisory authority. This point is very important. This is only advisory authority. Okay, whether you follow this or not, okay, they only just advise. Understood? And after this one amendment in 1996 was passed that allowed bank to use internal risk rating model. That means bank their own they can design risk model and computation of VAR daily using 99th percentile. है ना? Value at risk, है ना? Computation of value at risk daily using 99th percentile. Use of back testing, है ना? That means the bank they carry out their own testing, allowing bank to issue short-term subordinate debt with lock-in clause. That means you can see some of the mutual funds are being issued with a lock-in period of maybe 3 years, maybe 6 years, or maybe 10 years. That means in lock-in period, the customer they cannot withdraw their amount before this period. So moving ahead, because in Basel 1 requirement of measurement of capital adequacy in respect of credit risk, okay, and market risk. Keep in mind, in Basel 1 only the credit risk and market risk were considered, no operation risk. So this very important point is here. That means in Basel 1 only credit risk and market risk were only the. So they use the following method. How to calculate the CRAR, capital to risk weighted asset ratio. Capital to risk weighted asset ratio. So what is the capital fund? What is the formula? Capital fund tier 1 or tier 2 divided by credit risk weighted asset plus market risk weighted asset and operation risk weighted asset. So before this Basel 2, before the Basel 2 came in the came into force, there were only two risks, that means credit risk and market risk. So that time the formula was only that means capital fund tier 1 tier 2 divided by credit risk weighted asset plus market risk weighted asset, and operation was not there. Okay, in the Basel 1 the operation was not there. But nowadays we are using the correct formula. That means now operation is also included. This formula is very, very important. For examination point of view, I repeat once again. So this formula is written as per Basel 2. Okay, what is the formula? Capital fund, tier 1 and tier 2. So if you are going to find out only the tier 1 capital, then remove tier 2. And formula will be same. Divide by credit risk weighted asset plus market risk weighted asset plus operation risk weighted. That means denominator will remain same. Okay, and numerator will keep on changing depending upon the value which you are going to find out. Understood? Okay, then we'll see what is the CRAR requirement as per Basel 2. We'll be using the formula. Will come at the last. We'll do some numericals. So what is the minimum requirement as per Basel 2? So as per Basel 2, the minimum requirement is 8%. Okay, as per Basel 2, the minimum requirement is, that means we have to maintain CRAR as per Basel 2 8%, but as per RBI guidelines, our banks are maintaining 9%. So 1% more. Okay, but here are some restrictions also there. Banks undertaking insurance business, they have to maintain 10%, 1% more. Okay, new private sector banks, they have to maintain 10% because risk is there. Okay, local area banks very risky. Small banks are very risky. 15% they have to maintain. This figure you have to remember. Okay, for dividend declaration by the bank during the previous 2 years and current year, 9%. Okay, so for dividend declaration by the bank during 2 previous year and current year, they have to maintain the 9 years. So this distinction is there. You cannot declare dividend before you keep the 9% aside. Okay, now next, now we'll see what is tier 1 capital and tier 2 capital. Because I wrote here a tier 1 tier 2, so you must be getting confused what is tier 1 tier 2. Okay, so here's a list is given, so you can remember some of the this year this question is asked and very important is there. So first one is the page of capital. Tier 1 capital is very good capital. That means it can be easily converted into cash. Okay, so page of capital, है ना, statutory reserve, है ना, other disclosed free reserve, that means they have been disclosed in the balance sheet. Capital reserve representing surplus out of sale proceed of assets. So that means out of sale proceed of asset, whatever the capital reserve representing the surplus, keep in mind it is surplus, that means profit out of the sale proceed of the asset. Okay, paid up capital, I'll repeat once again, paid up capital, statutory reserve and disclosed fee reserve. Okay, these are the main. Then other than this, investment fluctuation reserve without ceiling, innovative perpetual debt instrument, but this must be maximum 15% of tier 1 capital. Okay, and perpetual non-cumulative preference shares less intangible asset or losses. So you have to subtract intangible assets or losses from the this perpetual non-cumulative preference share, or whatever the value total is given, you have to subtract it. So these were the main components which are included in the tier 1 capital. So tier 1 capital is also called core capital. This is the main capital, so it's also called core capital. Okay, now in addition to that, some total of innovative perpetual word is coming every time. So perpetual word you can remember here. Some total of perpetual instrument and preference shares as stated above should not exceed 40%. This can be asked sometimes. 40% of tier 1 capital. So perpetual, innovative, perpetual instrument and preference share, rest amount will be treated as tier 2 capital. So 40% will be in tier 1 and 60% will be in tier 2. This keep in mind. This question can be asked in the examination. Okay. So 40% make part of tier 1 and 60% part of the tier 2. Okay, so perpetual means you can see here, innovative perpetual debt instrument, maximum 15% in tier 1 capital. Okay, so this you can remember very well. Next, what are the main components of tier 2? So tier 2 you can see redeemable cumulative preference share, redeemable non-cumulative preference share, and perpetual cumulative preference shares form part of the tier 1 capital. And revalued reserve at discount of 55% is very important point. Okay, revaluation reserve at discount of, that means whatever asset we are having in our balance sheet, and if you are revaluing them, you have to take only 55% of that. General provisions and loss reserve up to 1.25% of RWAs. Hybrid debt, say bond and subordinate debt, long-term unsecured loan, limit up to 50% of tier 1 capital. So this you can throw because many questions are framed out of this. So you can just remember, have a glance. Okay. So question can be framed out of this. And tier 2 capital, sorry, tier 3 capital. In India, we are not following any tier 3 capital, and tier 3 capital is not part of the this Basel norms. Earlier it was there, Basel 2 was there, but in Basel 3 it is being not followed. That means totally removed. But still, we have to see some provisions are here. Tier 3, capital bank may at discretion of national authority employ third tier capital consisting of short-term subordinate debt for the sole purpose of the meeting of a proportion of capital requirement of market risk. Tier 3 capital will be limited to 250% of bank's tier 1 capital. Okay. So 250% means 2.5 times. Okay, will be limited to this. That means tier 3 capital will not exceed out of this. Okay. Similarly, you can see tier 2 capital should not be more than 50% of total capital. 50% of total capital. Okay. Now, we have to see two ways to improve CRAR. Okay. Now, CRAR we have to see how can you improve CRAR. But there are still some limitations. So, by raising more capital, because tier 1 capital, tier 2 capital, if you are increasing the numerator, your CRAR will improve. But what will happen? Raising tier 1 capital will dilute the equity stake of existing investors, including government. Okay, that means they will dilute the equity stake because you are increasing the capital. Then equity of the shareholder will diluted. Okay, raising tier 2 capital is costly affair because if you increase the tier 2 capital, then it is risky because you have to borrow money, and then if you borrow money, you have to pay the interest. Okay, and finally, it will affect our profit. So these are limitations are there. So you have to maintain a balance. Okay, then main this reduction in risk weighted asset by implementing risk mitigation policy. So this is very important because third point you can follow, you can mitigate the risk factor, then only your CRAR will increase. Okay, now there is one list that you can just see. You don't remember this list because if it is given, it will be given the question. It's very difficult to remember. So risk weight on different assets. You can see risk weights on different assets. Cash and bank balance 0 because is 100% can be converted to the same amount of money. Advance against NSC, KVC, FDs, LIC 0% because there is no risk at all. Government guarantee advances 0%. Central government guarantee 0%. State government guarantee 20%. Now risk has started. Okay. Government is government approved securities 2.5%. Next, balance with other scheduled bank having CRR at least 9%. Then with other bank who are maintaining CRR at least 9%, 20% risk is there. Other bank having CRR at least 9% CRR, 100% is there. Secured loan to staff means bank staff, 20% is there. Other staff loan not covered by retirement dues, 75%. Loan up to 1 lakh against gold or silver, 50%. Residential housing loan outstanding above 30 lakh, 75%. Residential housing loan outstanding up to 30 lakh. So it was above and this is below, 50%. And next, residential property, if LTV ratio is above 75%, then 100%. And residential housing loan above 75, 125%. Mortgage based securitization of assets, 77.5%. Customer credit card shares loan, 125%. And claims secured by NBFC, non-banking financial company, non-deposit taking other than AFC, asset financial companies, 100%. So this is the list. Yeah, you can see a few of them in the starting, and rest not required. If question is given, this will be given. Okay, and few more are here that you can see. Venture capital 150, commercial estate 100%, education loan in Basel 2 it was 75%, now it is 100%. Other loan agriculture export is 100%. So this is the list of percentage of risk weighted asset. How much percentage you have to take? Okay. Now Basel 2, some amendment has been done, and Basel 2 came in the picture. Committee on Banking Regulation and Supervisory Practices released revised version in the year 2004. These guidelines have been got implemented by RBI in all the banks of India. Parallel run was also started in the year 2006. That means 1st April 2006. In bank having overseas presence and foreign banks except RRBs and local area banks. That means these were implemented in. Complete switchover has taken place, but parallel was started, but complete switchover was done in 31st March 2008. Okay. So in banks with no foreign branch, switchover took place after 1 year. Means 31st March 2008, then 31st March 2009. So we'll see what is the difference between, what that means, what was difference between Basel 1 and Basel 2. So Basel 1 measures the credit risk and market risk. I told you that Basel 1 focused only the credit risk and market risk, whereas in Basel 2 all three type risk, means credit, operation and market, CMO, all type of risk, CMO. Okay. Risk weight, now as per Basel 2, risk weight are allocated on the basis of rating of their borrowing, that is A, triple A, double A, single A, triple B, double B, B, etc. Basel 2 also recognizes CRM such as CRM means credit risk management, such as derivative and collateral, etc. Okay, so this was the main difference between Basel 1 and Basel 2. That means risk rating was done in Basel 2, and all three risks were involved in the Basel 2. That means all were considered, all measures were considered. That means three types of risk. That means CMO. CMO means credit, operation and market. Within Basel 1 only credit and market, no operation. Now, three pillars were also introduced in Basel 2. Three pillars were introduced in Basel 2. So what are these? This question is very, very important, can be asked. Some of the people, they confuse that three pillars were introduced in Basel 3. Not Basel 3, Basel 2. Number one pillar is that minimum capital requirement. Keep in mind, sequence is also very important. Minimum capital requirement. Number 2, supervisory review process. Number 2, and market discipline. I'll repeat once again here. Pillar 1 is minimum capital requirement. Pillar 2 is supervisory review process. And pillar 3 is market discipline. Now we'll see one by one. We have will describe briefly. So pillar 1. What is minimum capital requirement? So first pillar, as per first pillar, CRR will be calculated by adopting same method as is discussed under Basel 1. है ना, same formula was there, with the only difference that denominator will have three types of risk. Okay, in Basel 1 only two types of risk was there, but in Basel 2 three types of risk are here, that is called credit risk, market risk and operation risk. That means risk weighted asset of all these three risks. I wrote the formula earlier. So what is called credit risk? So credit risk is the risk of default by borrower to meet commitment as per agreed terms and conditions. And in terms of extent guidance contained in Basel 2, there are three approaches to measure the credit risk as given under. So if borrower is not meeting the commitment as per agreed terms and conditions, that means he is not paying back whatever the EMI has been set, whatever the interest he has to pay, whatever principal he has to pay, he is not meeting that. That is called the credit risk. Okay, and here are the three approaches. These are very important. You can remember. When is something important there, I just tell what is very important. So number one, the standardized approach. Number is called standardized approach. Number two is called IRB, but IRB foundation approach, है ना? Internal rating based foundation approach. And third is also IRB, but it is advanced approach. Okay, so basically I'll be dealing here two types. Number one called standardized approach, and number two is called IRB, means internal rating based approach. Okay, so in the standardized approach, RBI has directed all banks to adopt standardized approach in respect of credit risk. Under standardized approach, risk rating will be done by credit agencies, and four agencies are approved for external rating. Okay, CAIR, Fitch India, CRISIL and ICRA. So you can remember this name here: CAIR, Fitch India, CRISIL and ICRA. So how they rate this, and what is the risk percentage? So rating as per risk percentage. Okay, here's the given here. Like AAA, if it is AAA 20%, I mean less risk. Risk percentage 20%. If it is AAA, double A 30%, now increasing. If it is single A 50%. If it is triple B 100%. Double B 150%. Means risk rating is going down, then risk percentage will increase. Okay, and after double B is okay, double B and below. Double B and below it is 150%. So I'll repeat once again here. Triple A is having 20%, double A is 30%, A is 50%, triple B 100%, and double B and below it is having 150%. And other than those who are not having the rating, risk factor is given in like education loan 75%, retail portfolio, SME portfolio 75%, and housing loan secured by mortgage 75%, commercial 100%, unrated exposure 100%. Okay, so this is the standardized approach. Our bank are following this type of approach. So as per the risk rating done by the external agencies, the risk factor is taken into account. Okay, now IRBA. So internal rating based approach, at present all advances of 5 crore and above, 5 crore and above are being rated from external agencies in our bank. IRBA is based on bank's internal assessment. So this can be asked. Bank's name itself is IRBA, internal rating based approach. Okay, it has two variant, foundation and advance. I already told you advance and foundation. Okay, bank will do its own assessment of risk rating, and requirement of capital will be calculated on. Now, what are the bases? Number one, probability of default. So that means what is the probability that a particular customer will default? Loss given default, exposure of default, and effective maturity. So bank has developed its own rating module system to rate the undertaking internally. Okay, and in our banking system, internal rating is being done or it is used for the following purposes. Okay, credit decisions, that means the decision is taken out before the credit is given to particular customer or advances are given to particular customer. So credit decisions are taken. Determination of power, because different mm, person holding portfolio or their designation, they are having different power. Manager is having 5 lakh power, senior manager having something other power, DM having something other power. So, and price fixing. Okay, that means in rate of interest deciding factor also it comes to play. So these are the three factors we have to take into account for the internal rating is done. Okay, so internal rating is being used for the following purposes. Number one, credit decision. Number two, determination of power. Number third is price fixing. Okay, now long term claims on corporate risk weight, long term rate, care, CRISIL, Fitch care, risk weight percentage. So care, like their risk rating is given here. Care AAA, CRISIL AAA, Fitch AAA, ICR AAA 20%. Okay, same thing previously we discussed now. Double A, double A, double A, double A 30%. A 50%. Triple B, triple B, triple B 100%. You can remember like this. B, below B, it is 150%. Okay, so this is the risk weight into percentage is given here. Same as previously we have discussed. Now, one more is given here. Unrated, if something is unrated, it is only 100%. Okay. Now, how to calculate is very important point we have come. So, how to calculate RWA and capital charge in respect of credit risk? We'll do the numerical also. First, we'll see the steps. The steps only just guiding given here. Number one, calculate fund based. Calculate fund based and non-fund based exposure. Number 1 point. Then allowable reduction, apply risk weight as per rating, calculate risk weight asset, and calculate capital charge. That means how much capital you are going to charge on that. Okay. Now we'll see one numerical here. Same steps we follow. 5 steps. Okay. Calculate fund based and non-fund exposure. Okay. Here the data is given here. Okay. Amount is always given in 000. You have to put after that. Nature of loan, limit outstanding undrawn portion, CC is 100. Okay, bill purchase 30, packing credit 10, term loan 160. Term loan is 160, outstanding 200. Out of undrawn portion of term loan, 60 is to be drawn in a year and balance beyond 1 year. That means 60 plus 140. Okay, 60. So 60 plus 140 means 60 plus 140 equal to 200. So now how to calculate? What is total outstanding? 200. Okay. Now 60 plus 160 is to be drawn in a year. That means 20% of 60. 20% of 60. How much you will get? 12. Then 140. Because and balance beyond 1 year. That means 140 is left. So 20% of 140 means 28. And term loan is 160. 160 minus 60, 100. So 50% of 100. So 50. If you make the total, you will get amount total outstanding. Okay. So answer is 290. Okay. So total exposure is 290. Now we'll see one more example here. Non-fund based exposure. How will you find out? So moving ahead, I'll just rub it. Okay. So type of NBF. So exposure is CCF adjustment exposure is given as follows. So I repeat it once again here. Total adjusted exposure is 290 plus 453, 743. Okay, and 000 has come here. So you can see once again here how we have done the calculation. That means first we calculated fund based, then non-fund based, and total is 743. Okay, now eligible financial collaterals means how this reduction will be there. That reduction is done with the help of haircuts. So we have come to the new concept that's called haircuts. Eligible financial collaterals, deposits being maintained by borrowers under lien. Okay, cash, including CDs, FDs, gold, government securities, NSC, LIC policy, debt securities, mutual fund, equity and non-equity and convertible bond are no more eligible in CRM. Okay, no more eligible in CRM. That means their maturity factor is counted as 0. Okay, because they are 100% secured. That's why they are not counted in eligible financial collateral. Okay, next formula for that means they are not eligible for CRM, credit risk management, because risk is nil. So formula for deposit under lien is given as follows. C star equal to C into H minus HFX into MF. So I'll just tell you what is the meaning of this. C is the amount of deposit. HFX is the haircut forex. And MF is the mutual factor. HFX is 0 if same currency is there. Means rupee. That means advances and your collateral both are having same currency. HFX is 0. Different currency 0.08, like dollar and rupee. Different currency, then we have to, your advance is in dollar but your collateral is in rupee, then you have to take 0.08 HFX in this formula. And so one more formula is here, but I'll just correlate both of them. C star equal to C1 minus HSX minus HFX into MF minus E into HE. We'll see the meaning, then we'll tell what is the formula here. So here's the formula of haircut. HE is the haircut for exposure and SC is the haircut for the collaterals. Understood? Sometimes this formula may be difficult for you, but I'll just correlate both the formulas. Okay, let's see here. I'll just see the second formula. C star equal to means, what is meaning of C? Whatever the value we are calculating after the haircut. C is the amount of deposit. That means collateral value. 1 minus HC in the bracket. 1 minus HC. HC means haircut for the exposure. Haircut for the collateral. Okay. HFX means haircut for the forex. Here the value is 0 if same currency and 0.8 it is different currency. Bracket close. MF means maturity factor. We'll do the numerical, then we'll see. And E into HE minus E into HE means exposure into haircut in the exposure. Okay. If now come to the first formula. How this first formula has been, if deposit under lien is there, that means no haircut. So this term will not be here. Okay, in the first. And because deposits and collateral HC, because it is under lien, so HC means haircut on collateral will not be there, because your deposit are having the 100% secure. So So that means from the first you can derive the second, from the second you can derive the first formula. So you have to remember the second formula. This is very, very important. I repeat once again here. C star equal to C bracket 1 minus SC minus HFX bracket close into MF, है ना, maturity factor, and minus E into HE. So we'll see what is haircut, है ना, because you'll be getting some doubts. What is haircut? Huh? It's not normal human being haircut. Okay, so haircut refers to the adjustment made to the amount of exposure to the counterparty and also value of collateral. I just take one example. Let's say you are having 100 gram gold. Okay, it may be having some value, है ना? Like just hypothetical value of like 35,000. So if you sell in the market same, you cannot get the amount. So we get some haircut. We reduce the value. So whatever you reduce the value, that's called haircut. So this is called haircut only. So there is always haircut in the collateral and your exposure in arriving your CRAR. So this is called haircut received to take the account of possible future fluctuation in the value of either on the account of market movement. Standardized supervisory haircuts for collateral exposure have been prescribed by RBI in their circulars. They are keep on giving the how much haircuts you have to take on which collateral and what haircut you have to give to which type of exposure. Okay, and when you reduce the value, means whatever you are getting the haircut. So when you reduce the value, you have to do like this. Means from E you have to subtract whatever value you got from the above. You have to subtract from E. Okay, from E you have to subtract whatever value you are getting. Means C star. Okay, whatever C star you are getting, you subtract from the ER because this is a reduction. So E minus C star. I will write here E minus C star. Okay, so you remember this formula. So E star is nothing but, so capital requirement for collateral transaction is this, means E minus C star. C star, if you calculate this, you will get only E minus this only. And you have to take maximum of this, means either 0 or maximum of this. Sometimes what happens, you get value get negative. So if negative is there, they will take 0. That means whatever value getting, that must be positive. Okay, so what is E star? Exposure value after risk mitigation. So you have to get the what is your actual exposure in that case. That means from E you have to subtract the C star. So C star is the haircut, total haircut. Okay. Now we see the numerical here. Okay. Exposure 10 lakh, 10 over 3 years is given here. Eligible collateral in A plus debt security 30 lakh with residual maturity 2 years. Haircut on collateral 6%. Okay. And maturity MF formula you can remember like this. MF formula T minus 0.25 divided by capital T minus 0.25. Okay, MF maturity factor. Small t is the residual life of collateral and capital T is the residual life of exposure. We'll be using the formula, this formula in the calculation. Okay, now see how calculation we'll be doing. See here. Okay. So value of adjusted collateral for haircut C 1 minus SC because there is no other terms. Other terms are not there because they are having same currency. I'll show you the formula once again. Other terms are not there. I'll show you the main formula. Yeah, this is the main formula. I'll show you here. This is the main formula. Okay, so HE is not there, so HE will not come. HF is not there, so HF will not come because same. So C 1 minus SC into MF. Okay, now coming back to the once again question. So C star equal to C 1 minus, yeah, C into, is into only C into S minus C, and MF will come calculate later on. Okay, so 30 1 minus 6%. So 30 into 94% means 28.20. Now MF will calculate and multiply. Yeah, MF is here. I told you T minus na, T minus 0.25, T minus 2.5, 2 minus 2 0.25, calculate 17.95. Okay. Now we'll see the second numerical. है ना? Easy. An exposure of rupees 100 lakh is backed by lien on FD 30 lakh. There is no mismatch of maturity. So MF will not be there. No mismatch maturity. MF not there. Calculate the value of exposure after risk mitigation. So here called serum is FDR 0. Okay. So SC here called on exposure is 0. So direct value will take. है ना? Because nothing is coming in the formula. है ना? SC is 0, है ना? MF is 0, everything is 0. So 100 minus 30, 70 lakh is the answer. Okay. Now, last question I will take here, how to calculate CRAR. Okay, this is the last question we are doing here. Tier 1 capital 1000 crore, Tier 2 capital 1200 crore, RWA for credit risk 10,000, capital charge for market. So they, instead of giving RWA, they are giving the capital charge, but you have to calculate into RWA. Okay. So from RW to get capital charge divided by 0.09 because CRAR rate. So to get RWA divided by capital divided by 0.09. This formula we'll be using here. This you can remember. This formula very, very important. Now we'll discuss later on also this. Okay. Now we'll take one by one. RWA for credit risk 10,000 crore is given first. You can see first value. RWA for market risk 500 divided by 0.09. Market they have given. So 500 divided by 0.09 will get this value. 5,556. RWA for operation risk 300 there you have your capital. So capital divided by 0.09. 3,333. Okay. What is total RWA? You add all these three. Okay, add. So we got the denominator part. I told you the formula, है ना? Capital divided by two or sum of all risk. So we got all these three RWA. Now see the tier 1 capital. Tier 1 capital 1000 crore here given here. And tier 2 capital 1200 crore. But here for the calculation of this, tier 2 capital cannot be more than the tier 1 capital. So tier 1 capital is maximum 1000 only. Even though it is 1200, will take only 1200. Why? Because tier 1 is 1000 only. So we cannot exceed this value. So tier 2 also will take 1000 only. Make the total 2000. Okay. Now tier 1 capital divided by total. That means when you are going to calculate tier 1 CRAR, tier 1 capital divided by total RW. That means 1000 divided by whatever total we got 5.29. Okay, so total RWA we got here. Just see the figure once again. I'll just show you. I'll mark here blue. Okay, this is the total RWA. I'll mark here blue. Okay, this is the value given here. Okay, so this will come in the denominator. So 1000 divided by, because we are finding only tier 1 first. Okay, now total CRAR, total capital we got 2000. So 2000 divided by, again same value, all three, RWA, then we are getting 10.59%. So in this way we can calculate CRAR, and but what we can calculate tier 1 capital we are getting very less, 5.29. So we 9% as per India and 8% at the international level. Okay, so with this we finish our class. Please stay tuned with me, and you can share with your friends who are revising. And I once again reiterate that we are going fast, and it is only just revision class. If you want have some doubts, you can refer your book of Macmillan publication. Thank you very much. Stay tuned with me. Have a nice day. Good day.